Everyone, welcome back to the Market Chat. My name is Richard Moglen. Just today is Anne-Marie Baiynd of thetradingbook.com. And Anne-Marie, I'm really excited to have you on. Welcome to the show.
Thank you so much. I'm excited to be here, get a chance to talk to you.
Perfect. And we're going to cover a lot today, including current markets, options trading, a lot of mindset, because you do have some experience in that area with some research into neuroscience. I'm really interested in diving deep into that. And of course, we'll cover your overall trading methodology. So to start things off, I always love hearing about people's backgrounds, how they first got interested in this business. And yeah, I'd love to hear just kind of how you first dived into the market.
The road's been pretty long. I'm coming up on my 20th year, and I've been in a couple of businesses beforehand, and I was just really tired. I wanted to change. And I'm normally a little bit introverted. And I thought, you know what, I'm going to find something that I can do in my office at my desk.
Right.
And I sent some of the folks that were working with me in my prior business to a Success Magazine event. And there was a guy there and he was talking about technical analysis. And I thought, what? This is easy. I can do that. And I literally immediately after leaving that, I said, you know what, this is the next step for me. And it really was the perfect blend because I had owned a recruiting company. And before that, I was a neuroscience researcher. And before that, I was a mathematician and a statistician. And so just the knowledge of people and probabilities just sort of came together in the giant world of the market. And so I saw it and immediately fell in love with it. It didn't love me back. It took me about 3.5 years before I really figured out what I was doing. And then learning, when you first figure out what you're doing, then you have to figure out how not to do that and do the right things. And then you've got old habits that you need to change. And so every day was, that one step in the right direction, 2 steps forward, 1 step back, 3 steps forward, 2 steps back. But, the work is hard, but entirely worth it, entirely worth it.
Absolutely. And I think a lot of people can relate to that 3 steps forward, 2 steps back. Even sometimes it's 3 steps forward, 4 steps back, and you just got to kind of reset and keep going.
Yeah.
And it's super interesting that you've got that kind of STEM background, being a mathematician, and pairing that with your knowledge of psychology, the brain. I feel like that gives you a really interesting background and awareness about a lot of the things that go on, like in between the ears of a lot of traders.
That's true. And what's very interesting is that even though we know it, and we go, oh, okay, this is cognitive bias. This is what's happening to you. Of course, Anne-Marie, this is cognitive bias. And yet you'll make the mistake, even though oh, wait, that's cognitive bias. And so knowing it gives you a little bit of a leg up, but it's all about stepping back and saying, I know this is bias, but what am I using to make those anchors? And so we can talk a little bit about those anchors when we get down to the actual psychology of the market and how we feel about money and that sort of thing. And that ends up giving us the real work to do as a trader. Can we find the anchors that are helping us make bad decisions and learn to unhook them and create new anchors from which to make better decisions?
I love that. And I definitely want to dive deep into that. But before, I'd like to hear a little bit more about your background. And I'd love to ask just kind of, were there any traders out there who really influenced your style, who maybe mentored you? And also, were there any kind of trading books that you found were really helpful along your journey?
Okay, great question. When I first came into the market, it was about 2005. And I didn't know about message boards. And I had just happened to find out about Twitter maybe a year after that. So I was really sort of looking around places like Investopedia and Fidelity and all of the big spaces that tell you a lot of nebulous things, but don't really bring you to an execution event. How do I make this trade actually go? I'm told about, hey, this is a buy, you should risk about X. But if I go, wow, if I risk about X and this is a buy and it's run up X plus 5, I easily could get into trouble if I don't wait for a pullback. And so the first 18 months or so were really very, very tough because I was, watching CNBC and then trying to figure things out from TD Ameritrade, snapshots of this, that, or the other. And I could not find anything cohesive because really back then, there were a lot of people that had this philosophy. If you know something's working, keep it a secret because the second you tell someone, it's going to stop working. Mm-hmm. And that might be true if it's arbitrage, meaning you're trying to make money between what price should be and what a group is making it out to be at the current time.
Right.
But that's not really true in the grand scheme of things because none of us have pockets deep enough to move markets unless we're moving it as an entire group, like we see the Reddit people do, or in the past year, right? And so that was a very lonely space. It was very, very lonely. And when I found Twitter, it was about maybe 3 years later. It was kind of early in the game, maybe 2 years later. I found a few folks like Brian Shannon, and I had seen Peter Resnicek from the TD Ameritrade Network, and so he talked to me about market internals and that sort of thing. But other than that, I was really a very stubborn person, and so I thought, I've got to figure out how this makes sense to me, because I'm going to be immediately asking why with every single statement being made. Why is that true? Why is that true? Why is that true? And so that's really guided me along the way. The question, a lot of people say, don't ask the question why, because really for the truth of the why, we don't really know, but we can know based on what everybody else is looking at. Well, everybody's thinking this is going to happen. So that's really why. And so it became learning to look at how crowds move. And in the area of psychology, it's a well-known fact that you can predict what a crowd can do with much higher reliability than you can predict what an individual can do. And so that helps us in looking at charts and seeing what's going on in the broad market, because crowds will be far more reliable to gauge than individuals.
Very interesting. And I'd also love to hear about during this journey, what were some of the common mistakes you made very early on that most likely a lot of new traders are going to go out and make the same mistake. So maybe you can offer some advice, warn them a little bit, and maybe they can learn from your experience, basically.
All right. So I did not manage risk very well at all. I did not know how to look at a chart and go, okay, you're wrong. You've got to get out of the trade.
Right.
I would sit in there until it would either evaporate into nothing, or I would be down so much that I would have to take the loss because of a margin call, or anything like that. In terms, if you sell a call or you sell a put naked, if you get put to it or you get a margin call, it's very psychologically debilitating. So I did that. I did not manage risk well. I flitted from one thing to the next. I would take a look at something and go, oh, that might work. And then I would give it a few tries. And if it did not transform into something magnificent, I would go looking for something else. And so I continually was on this search for the Holy Grail, when really what I should have been doing is saying, wait, what are the known knowns? I know that they're known unknowns, and I know that they're unknown unknowns, but I need to start with the known knowns. And so if I start there, and then the first thing I have to do is manage risk, then, I'll be able to start building my account up because I had decimated it. Yeah. It's bad.
Perfect. And knowing what you know now, how would you define risk, and what would be kind of your advice for people who are having that trouble of managing risk and are letting their drawdowns really get out of hand and are feeling that pullback in their overall accounts?
That is a great question, Richard. And it's a multi-layered question depending on where your experience is with the market and whether you're able to look at a chart and go, where is the real risk here? And see, many of us look at a chart and we maybe look at a near-term support and we go, okay, that's my risk. And we will say, okay, well, it looks like it's about 4%. I'm going to take 4%. It'll come in and we'll disobey it.
Yeah.
We'll go, well, maybe I was a little wrong. Maybe it's 6%. And then it drops another 10. And then we say, you know what, it's down so much. I just need to hold it until it turns around. And so the number one thing there is when you make a rule, make sure that you obey it. And I'll talk to the folks who have jobs that they report to someone, or if you are a parent and there are clear known rules that you set out for your children or that your boss or company has set out for you. Hey, listen, you can't expense this. You can't do that. There are rules. Everywhere we are in life, there are rules. There are traffic rules, right? We don't run a red light when things are crazy or we're going to get T-boned.
Right.
So in the space of trading, the only person to ultimately be accountable is us. And that gets very difficult. We have a tendency to let ourselves off the hook. If you haven't read the book, Daniel Kahneman's Thinking Fast and Slow, which a lot of people know of it, but it's really worth a read. Two things he says are, everything he says in there is just groundbreaking. But two of the things he says that are super important to me are, one, we have to realize that we tend to give ourselves much more leeway in terms of when we're wrong than a system. When a system is wrong, we have no tolerance for it. When we're wrong, we're like, we try. And so when we realize that we are much harder on systems and strategies than we are on ourselves, we ask the question, okay, where's the real space? And it's somewhere in the middle, right? We need to hold ourselves more accountable, and we need to let technical strategies have a little bit of wiggle room and not be perfect.
Right.
And so saying that and understanding that makes us realize that when we have rules, we need to follow them. And so the first thing is to look at yourself in the mirror and go, when is the last time I said, hey, this is my stop, and I didn't take it and I let it fall? The flip side of our mind will go, yes, but this other time I did that and it held. And so here's the next thing our mind has a tendency to do. Our mind has a tendency to remember exceptions rather than the rule. Remember the old game? Well, you probably don't because you're very young, but there was a game on a show called Sesame Street. Maybe you've heard of Sesame Street?
I watched Sesame Street.
Okay, so remember the game, one of these things is not like the other?
Yeah.
One of these things is not like the other. One of these things is not the same. Which one is different? Can you tell? And so our brains are automatically geared to go, that's different. That's why we have a tendency to pick out people who look different to us in a crowd. And it's also a tendency that we have to hang on to those differences and maybe amplify them in terms of how great they were for us holding something on. Yes, but this last time, and this is a game of expected outcomes. So when you're looking at the trouble that you're having, let's say you're you are really having trouble with risk. And you say to yourself, well, I feel like I don't set risk properly. I'm going to show you a couple of things that are really straightforward on how to do that. The second thing is, you might be looking at risk and saying, I can't obey that rule, and you will die a death by 1,000 cuts. You have got to set rules that work and obey those rules through the course, even though they aren't looking great right now. Expected outcome is going to give you a positive result if you're working with a good strategy. And most good strategies are very, very simple, very straightforward. We also have a tendency to look for complexity. Now, here's the thing. If we wanted to know exactly what the very next 2 ticks are over a chart, we can combine enough variables together to build something magnificently complex. And that's what chaos theory tries to do. Chaos theory says, listen, the underlying is a grand program of immense complexity, but if we find it, we'll be able to tell what's next. They haven't gotten to the edge of that yet. They're still bumping into all kinds of things that stop chaos theory from coming to a fruition where we have some grand unified formation, but we'll still battle for it. As analog creatures, not digital, right? We move slower, even though our mind and thoughts move at the speed of light. We don't interpret them at the speed of light. We interpret them far slower. And so what we have to do is realize that we have defined skills, and those skills have strengths and weaknesses. And so when we try to find a strategy, we go, what am I good at? For me, deep thinking is my nice little basket. I'm not good at throw me a ton of things and I can look across the top and immediately pick something. That's not my wheelhouse. So I will look at something and I will think about it deeply, and then I will strategize, and then I'll just look for my points of entry. And I'll say, okay, here's where your event is going to start, and this is what your risk is. If you are sitting in a price point where that risk is much lower than or wider than the risk that you see in the chart, you need to sit and wait until there's a new event that allows you to raise that risk threshold, or it comes back into your original risk threshold. Other than that, you spend a lot of time sitting on your hands waiting for price to come to you. And that is a very alien thing for some people. A lot of people who love intraday trading will chase trades out. Also, I'll show you something very good to look at so you can see if you're chasing something, when to start getting nervous in the chase. There's a place for you to go, oops, I need to be careful right now and take some profit. I'll show you that also. But those two sorts of things really work against each other. And most of us want to get in, make a ton of money, and leave. Here's a hard truth. Trading for a living is very, very hard, but it's also incredibly rewarding. And if you do not want to work for anyone else and you want to have your own schedule, there is no other occupation that I can think of that just about any person can do if they train themselves up right. Of course, a writer can do that, and a software developer can do that. They can work anywhere from the moon, whatever, but that's a very defined skill, right? There are people who are just very good at those things. And I think trading can be really a space that Joe Normal gets into. And if he's just careful with a few rules, he's going to do, or she is going to do all right. And some of us are going to just blow the doors out of things and become amazing superstars at it. And some of us are just going to get by. That's just like every other thing. Pick baseball, pick, everything. We can't all be at the pinnacle of success. And some of us really overestimate what abilities we have to do what we have. And so the question is, why do you want to trade? And if the answer is because I'd like to drive a Lambo or own a $17 million estate on the water, never a good reason.
Yeah.
Money is never a good reason to do something, because you'll make the wrong decisions if you're just chasing cash. Money has a tendency to warp our sense of balance. I'll put it that way. And so, for me, I live out of a suitcase between October and March because our youngest child plays college basketball. And so we pack up suitcase, season starts, and we're gone until the end of the season. And so freedom is a very big thing for me, which is why, and I love working for myself. My husband says it's because I don't play well with others in the sandbox, but he might be right a little bit, but not. I play well just so long as you're not telling me what to do.
Right.
Yeah, I have a hard time with a boss. And so it just worked out well for me, but it was very hard because I had to learn how to make myself truly accountable to process. And if I make myself accountable to process, the results will follow.
Absolutely. And just getting back to one of the points you mentioned about we're always looking for that holy grail indicator, the really complex system. I think everybody falls into that trap at the beginning.
Yes.
I've noticed that among the traders who I interviewed who have done this for 10 plus years and are successful, their charts are incredibly clean. They're almost always pretty much price and volume and maybe a few extra indicators, moving averages, but really they try to keep it as simple as possible. And their systems are often as simple as breaking a downward trend line. It's not the MACD's up at this level while the RSI is down here. It's keeping it as simple and repeatable as possible. So I think that was a really great point.
Exactly. And let's think about mentally why that is, okay? Yeah. How do we repeat things, right? We repeat things if they are straightforward, and we can learn a pattern and go 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4. Now, let's start putting a timing mechanism on it, like the market going up and down and moving sideways. And then let's add the added pressure of, hey, it's your money that you are working with. Those stressors that come from a static event where you can look at a chart and go, yep, when it breaks this, I'll go short. When it breaks that, I'll go long. That's simple when it's static.
Yeah.
When it's dynamic, your brain is constantly in the struggle of, wait, is this right? Is this wrong? If I'm wrong, what's the risk? If I don't get in right now, what's the risk? If I'm right, but I wait, what's the risk? And so our brain is constantly moving through what if, but it really is what if I'm wrong.
Right.
And so that real question gets answered when you quantify the risk and you go, listen, all the buyers are sitting right there at this ledge. I'm going to wait until it comes into those buyers and then I'm going to buy, or I'm going to wait for it to come off of that level and that'll be my stop. Right? And then you stop asking the what ifs because before it happens, you know what you're going to do. It's sort of like, any guy who comes up to the plate and he says, all right, this guy, I know what he normally does. He's going to come in, he's going to low and down, and he's not on tonight. He doesn't have his stuff, so I think it's going to be a ball. And so you're not going to swing. At the
Mhm.
same time, the guy that's throwing the fast pitch every time, hey, all his ball is doing is floating right up. It's a beach ball. I'm just going to swing right through it. But that happens before. And so trading, a decision to move has to be made before the move,
Yeah.
knowing the risk so that you can say, all right, I'm buying it here, and then I'm going to do that. So now you think to yourself, well, what if it only does it one time and it moves straight up? And then all of a sudden I'm, looking at something that's chased out. One, you can see how far you can go and you can say, hey, I still know what my risk is. Or you can say, you know what, I'm just going to wait for it. If it doesn't come back, I'll look for the next setup. And many of us don't realize that the decision to move has to be made before things actually occur within the parameters of, okay, is my risk established here? Right? So you don't buy as a candle is falling to the ground when you see there's a 10% fade, that it's likely, wow, I don't see any candles sitting around within, 4 or 5 more percent. You don't move. You let the chart come into the level and don't anticipate that it's going to leave you. So one of the human frailties is our fear of being left out.
Mm-hmm.
We don't like being left out of parties. We don't like being left out of groups. We don't like being left out of secrets. We don't like it at all. And so this FOMO, or the fear of missing out,
Mm-hmm.
is always pushing on a trader that says, oh, this is going to move. I want to get it before the move so I don't miss out. Many times, for you not to miss out and jump in without having a drawdown, there's got to be a tremendous amount of strength showing in the market. And most of the time, that strength isn't there. And if it is there, it's not there for long. It will always come back. It'll come back and retest an old level. And so what we have to do is realize, hey, listen, I have a personal insecurity. That insecurity is I don't want to miss out. But in the market where it's my money, it's okay to miss out, just so long as I know when I'm getting in, I've set all my rules. And those rules are attractive to me in terms of risk. What I notice with traders, and I do work with a lot of traders, I notice that many more of them run out of money before they learn to trade because of the inability to manage risk.
Mm-hmm. I love what you said there about how you have to have the setup defined and your risk defined before entering a trade. I think that comes back a little bit to a little bit of the fault of social media, because Twitter especially can be an amazing resource and there's so many great traders sharing ideas in that. But I always say that you can't just see a trader post this ticker and be like, oh, they like it, I should buy it right now, because they might have bought it 5% ago, and their setup, their risk tolerance, their situation might be completely different than yours. So I love that. And I always say that you should always have your setups defined before the market opens, and then it's all about just executing the plan you've already laid out, position sizing, risk management, stop loss, all of that. You can define that before, and that goes back to the psychology, because that gives you peace of mind. As you said, you don't have to make that decision. You've already made it. It's just about following what you've already written down on the piece of paper.
Exactly. And many of us don't trust ourselves. That's particularly with women, though not. I think women tend to make if they're thinking through things, they'll overthink things a lot. And then men have that impulse that says, oh no, you're not getting in front of me, I'm going. And so both of them have those weaknesses, but together they make a good mesh in terms of saying, hey, maybe I ought to think this through a little bit more, and the other person needs to go, well, maybe I ought to think this through a little bit less once I've found what the region should be. Now, I want to interject something.
Mhm.
When I say, listen, you want to look at the area and choose the area that looks like the support zone, so you know when it comes in there, that's where that decision is going to be made. It does not mean put a limit order out at X. What it does mean is when that price action shows up, you go directly to the chart and you watch what the traders are doing. Because remember, a crowd can be predictable, whereas the individual might not be. And so the crowd might be saying, hey, we're going to stand right around this decision. But somebody who might have a lot of exposure would come into that area and go, I got to get out of here. And they'll bring the dip and wick down. And so if you set a limit order and it wicks you out, and this has happened to a lot of us a ton of times, we know that's the support zone. We take the trade in a limit order, it stops us out, we get cold feet, and then we watch it, run off the rails without us. Remember that one wick, those few ticks, small group of people losing the threshold. And once it actually begins to hold, once you stop seeing wicks below an area, that's where you go, that's my stop. Because if it loses that edge, it means all those buyers that were protecting and defending that support zone are there no longer, and the chart is going to fall. And so understand that that's how crowds work.
Yeah.
Crowds, if all of a sudden everybody's holding that and all of a sudden they're not, that is going to fall. And so that's a really good way. When you set up a trade, don't set that limit order out there unless everything else in the market is pointing in the direction upward. You just need to let it stabilize, and then you can decide where you want to act.
Absolutely. I love that. And I'd love to lean a little bit more into your neuroscience research background
Sure.
and get your perspective about kind of what's going on within our brains when we're dealing with stress, dealing with decision making while trading, and how these emotions come into play and might short circuit the actual logical areas of our brain. We're trying to make the objective decisions and follow our rules, but instead we kind of act only based on the fear flight response. So I'd love to hear your take on all of that, Anne-Marie.
All right, super. Well, the brain has the power to send all kinds of chemistry to flood our body.
Right.
And so the chemistry of fight or flight is something called cortisol. The strange thing about cortisol is that when it's released into the brain, it prevents the prefrontal cortex, which sits in the very front, that's higher function and system 2 complex decisioning. It prevents that from acting in its best way. And so when we're sitting at our desk and we are in the midst of a trade, or we're getting ready to go in a trade, if we can sense that our heart rate is spiking up, or most of us hyperventilate at a desk. We do not breathe deeply, and we breathe through our mouths a lot. We should really only breathe through our nose when we're sitting at a desk. If we're doing yoga and we're doing energy expulsion and that sort of stuff, if you're into the yoga game, then yes, you've got some mouth breathing there. But by and large, everything through the nose. And so we'll get just the right amount of oxygen. So let's say a trade starts going badly. The first thing that happens is the release of cortisol. That's the stress hormone, and it sits in our midsection also. You see those commercials that go, hey, stress, life at the desk, and it's the guy with the great giant belly. And so cortisol does allow fat to get trapped in our midsection, because what it's doing is storing energy to run, right? So at the same time, it shoots off into the brain, short circuits the prefrontal cortex, and we're sort of caught like a deer in the headlights.
Mm-hmm.
As a trader, we can all remember a time, and it might even have been today, where we look at the chart and we go, that wasn't supposed to happen.
Yeah.
What am I supposed to do here? That event, it will automatically start triggering the release of cortisol. For us as traders, we have to realize that we can't help autonomic response, but we can help response that is controlled. And that is, okay, take a breath. Where is support? Where is resistance? Did I break something that I shouldn't have? And do I need to cut and run? Often, what we will find is that a giant spike of price will trigger that something's going to happen.
Yeah.
And we have to sit tight and go, okay, does this candle need to close here? Yes. All right. I can raise my stop. I can lower my stop. I can pull off some profit right now. But the first thing, when you feel yourself do that, both your palms on your desk, face down flat, straighten your back, and take a deep breath through your nose and out again. Just a couple of deep breaths. It'll still you down. And then the questions you ask are, has this broken my stop? And I didn't have my stop in, and it's breaking down. Or is this breaking out and going someplace that I don't know if it's going to stay there? What happens to us is things break out. And before the candle closes, we go, that's it, I'm in.
Mm-hmm.
And remember, it's the body of the candle that is really telling us what the group is doing. The wicks don't really do that unless the very top of the wick or the very bottom of the wick, right? Because it stops the motion, and we know the predominant participants are going to be pushing it back up into the candle body. So my philosophy is this: if you trade a 5-minute candle, wait until the end of that candle until you enter the trade. Wait until that confirming candle has closed. Look at where your risk is, and then go, all right, I'm going. Let's say it's a little further away and you were planning on taking 100 shares and you see it breaking out, take 50.
Mm-hmm.
If it comes back to your original buy spot, you pick up the other 50. And then that way, you really have not expanded your risk by much, not twice as much as it would have been. You know, trading, it has a lot of gray space. That's really hard, right? We have something that breaks above a ledge and we go, wow, this has been really moving downside. Looks like it's a continuation move, but all of a sudden, you know, instead of continuing to move down, it's stopped. So what would normally happen? And this is all about, you know, the wisdom of crowds. If a chart has a trend of a negative trend, and all of a sudden it begins to bounce, how does a bounce occur? A bounce occurs when people buy. Mm-hmm. What kind of people buy? People buy who are buying to open, and people buy who are buying to close. Mm-hmm. Either way, it's going to move price up. And so if we're in a short and we see price action begin to move up, we might say, you know, I need to take a little profit. It's shy of my initial target, but that profit zone maybe doesn't quite come right where I want it. And so I have to take it a little bit early. You let it go up. And if it comes into known resistance and it begins to fade again, you can add back to that shorting action instead of saying either, oh my goodness, this is a brand new long, or I've just got to get out. I notice a lot of traders are either all or none because they can't, their gears get ground up just a little bit in a half size position. Well, what do you mean? If I'm half size, if I were whole size, I could get all the profit, because our brain doesn't go, well, if I'm half size and I break down, I'll take half the loss.
Right.
And so there's that, I am a very conservative trader. So the things I say, people might go, yeah, I'm not down with that. But what you have to find out is, where are your definitive edges? And are you obeying them? A lot of us like to be gunslingers, but really the sharpshooter is the one who's actually going to make the target and use less bullets. Right. And so learning to be a sharpshooter, hopefully that doesn't offend anyone that maybe doesn't like shooting or whatever, but I do. So I'm using that term.
It's a good analogy for sure.
Yeah, right. Yeah. You either are slinging buckshot there with a shotgun and, throwing spaghetti against the wall, or you're being a rifleman and you really are becoming more exact. And the more exact you can become and set your trades up, the better you'll see your portfolio perform overall.
Yeah, for sure. And going back to something that we talked about in our call earlier before we started recording, I talked about how actually one of my worst weeks ever trading, where I made a lot of bad choices and let things slide a little bit more than I had to and should have. I was going through final exams. So I was experiencing a lot of stress outside of trading. So I'd love to hear about your thoughts on that and how outside stressors can impact basically our trading performance in general.
Right. Well, the truth is, outside stressors will impact everything that we do, right? It's about how much mental strength we've developed, not how much we have, but how much we developed. And one of the things that I like to talk about is this sense of we think willpower, or just driving down and just keeping after it, will somehow give us the end result. And the fact of the matter is, we all sit on a spectrum, and some of us have to take a breath several times. Some of us can do it with all one breath. And we have to understand what is about us. Now, for people that are self-directed, they will have a hard time piling everything on and doing one thing after another. The hardest time of the year for me to trade is basketball season, because I'm living out of a suitcase. Right. And everything is like tomorrow. I have a 6 a.m. flight. I came in last night at 9:30. So I literally had one day to turn everything around, and then I'm back out the door. And I sit down at my desk and I go, oh gosh, I got to find a trade. I got to set up a trade. And if we can say to ourselves, you know what, I'm prone to being like that. So you want to put an eye out for it. Sort of like a friend that you really care about that says, hey man, quit smoking. You don't take them to a bar where everybody's just lighting up. Right? So you watch for yourself and you go, you know what? You're going to take a 20-minute walk. You're going to say, listen, just study charts. I know you think you're looking at some real big trades here, but you've got a lot of other things. And the market is a buffet. It's open all day, anywhere you can find it. There's a good trade waiting for you on the other side. Learn to convince yourself that it's okay if you miss out.
Yeah.
Because, if you have trading friends that come to you and they go, oh my gosh, did you see this? It moved 15% today. And in your gut, you're like, oh, man, right? We cannot help that. We actually do that almost every single day when we're trading, because we'll look at the market and we'll go, oh, the market was up 3% and I'm down 1.5. How could that be? We're always using that gauge out there. If the market's running off the rails and we're not having a good day, somehow we did badly because the market did great. And we have to stop using those outside yardsticks. And we have to say, wait a second, why am I sitting down to trade today? Well, I believe that we're sitting in a space where my 5 favorite ones are looking at key support zones. Sounds like a great place to set up some trades. If you come in and you go, I have no idea where I'm going to trade today, let's see what's happening, you might be able to find some, but it's better that you study until you find something that's just rock solid, that obeys all your rules, that you can take it. Because I used to have this one person that would say, you can't put so many rules around things that you can't get in, and then you'll watch things just run without you if you don't get in. But that person was using, a coin toss to get in and out, and the expected outcome was absolutely terrible. So find 2 or 3 rules and make sure they all apply, and learn to say, I'm either going to look for a stock where it is applying, or I'm just not going to take the trade. Some of us are addicted to the adrenaline rush that comes from trading.
Right.
I am an adrenaline junkie. I'm going to fess up right now. Huge adrenaline junkie. I love the markets. They are an incredible place of excitement for me. I hope I trade until I'm 105, frankly. I come in because I'm like, okay, how are people going to really manage this? How are they going to do this?
Yeah.
And so when we're addicted to the motion and the rush of having that good trade, it's just like any addiction. You've got to have boundaries, or you're going to end up in the gutter.
Right.
I mean, that's harsh, but it's true. You're either going to be in a dumpster or the gutter. It's not a good thing at all. And so you pull those governors back. That's why you hear some folks go, trading ought to be boring. And although I'm not one of those people that says that, because I can't even imagine anything about trading being boring, I do know that my trades are rule-based. And if I am not following my rules and I get in, I'm going to lose money. I am going to lose money. So if I say, you know what, I don't really feel like losing money today, okay, great. I know what I'm going to do. I am going to sit out until my rules hold.
Perfect. And I kind of learned from that experience when I was doing that final exams. And this year I was doing a lot of traveling, visiting some national parks along the way to Seattle with my girlfriend. And I decided, I'm just going to go to cash, enjoy my trip. And that kind of de-stresses everything, because I can enjoy my trip a lot more while not having to focus half my attention on the market. So I think what you said was 100% true. And I'd love to hear, Anne-Marie, more about the anchors that you mentioned earlier on in the interview. And yeah, if you could just kind of expand a little bit more on that topic.
Okay, so when we are growing up, we have anchors that set off triggers in our mind. So for instance, the strongest anchor of anything is smell. And it's because smell comes directly through the nose to the brain. There's no filter. Everything else comes through the amygdala. And the amygdala is that little thing. It's almond shaped. It's the base of the brain. All of our things come up there. But smell is one of those things that automatically triggers, oh my gosh, I remember being in my grandmother's XYZ. So that's a basic anchor. Other kinds of anchors come from a parent or someone that you really respond to, no matter what they say, whether you respond negatively or positively to them. And they create anchors that give you a sense of how you feel about you. And so many of us, sadly, are self-sabotaging because we have anchors that are illogically hooked. So for instance, let's say we had a female in our life that was tremendously manipulative, right? We're just picking worst cases so you can see how an anchor and how it comes around for things. So let's say that she always said to you, hey, Every time you do that, this happens. You just can't make good decisions. That's an anchor. And that kind of anchor finds itself in the money space as second guessing. And it's second guesses, and you will stop trusting yourself. And if anything goes wrong, it reminds you how not good you are at things.
Right.
Okay. So for me, my anchors, I had a very demanding dad, and I could never do anything right. But something about who I was intrinsically just never wanted to give up. I just was not somebody that liked giving up. I would just try and try. But see, I would always know, no matter what you do, it's never going to be good enough. And that's never going to be right. So I was the queen of the second guess. Mm-hmm. The second thing is the person who feels like, hey, maybe I've had a lot of luck that didn't go my way. Everything's, this happened and then that happened, and then this happened and then that happened. So we have somehow a sense of the fact that we're unlucky. And so that anchor sits there. And when we go into the money space, we'll wait well past what our event tells us to do, because, well, if I do it here, I'm usually unlucky, so I'm just going to wait. And so we stop having the ability to follow rule-based parameters, right, because we're always thinking, I'm not lucky, so if I buy it here, it's going to fall. And so I've got to wait. And what we'll end up doing is waiting literally until the broad global mind says, that's time for me not to trade anymore. And when we get in, they're getting out.
Right.
That's happened to me 100 times, right? I'll wait and go, oh, well, that's at resistance because I'm sitting in the wrong trend. So we have those, notice, they're not anchors that have to do anything except raw emotion. Mm-hmm. And it's the emotion of self-worth. It's the emotion of feeling like you deserve success, and the emotion of, this one's a little harder to put into words, the emotion of learning how, maybe it's not emotion after all, but it is filling me with emotion. It's the sense of coming back and saying, okay, what negative self-talk would I have for myself here? Mm-hmm. You're such a moron. Look at that. Or whatever, right? I mean, fill in your favorite expletive. Right. We have a tendency to do that. And here's my thing. The whole world is ready to tear us down, right? If you get very successful, somebody wants to see you fall off a cliff. They only love you as the underdog until you start getting some light shown on you. And then, they want you back to being the underdog. Nobody loves promoting someone to that level of whatever, unless there's something directly in it for them, or they've learned to grow as a human being, right? Mm-hmm. In general, it's always about me. It's always about what I want. It's always about what's working for me or not working for me. And so when things go badly, we have this tendency to say bad things about ourselves, and that negative self-chatter, you think it might not do anything, but all it does is revert you back to being 5 years old and getting called down by the authority figure that says, you're just good for nothing. Or when in the world are you going to start behaving? Or whatever it is that they might say to us. And so there's got to be a space where you stop negative self-talk. And whether you believe it or not, it is directly impacting your performance. Treat yourself like you would that same 5-year-old child that you're trying to help to grow and nurture. Hey, if you had to do this over again, what did you miss? What did you miss? Was there something that you were hyper focused on that maybe you should have had a wide angle on, so that next time you can go, you know what? I had a wide angle focus there. That was not the right one.
Mm-hmm.
Those sorts of things, and then write those notes down. A lot of people say, hey, listen, the good trades take care of themselves. You just focus on the bad ones. Listen, when you focus on the bad ones, all you're doing is repeating the worst events over and over again. Ooh, let me see what I went in there and I did that. Okay, all that was bad. No. You go to the good ones and you go, ooh, why did this trade work out? Oh, this line was right where we're supposed to be. That line is right where we're supposed to be. Learn to positively affect the chemistry in your brain. You must positively affect your brain chemistry so you can move against the battering ram that is the market. The battering ram that are the people that go, you're doing what for a living? You're trying to do what? You've got to block that out. And the way you do it is by nurturing and saying, hey, listen, I know if you'd have done that, that would have been the wrong thing. And you can see over here in that trade, that's exactly what you did. And so this trade worked out well, and it's because I did this, this, and this. And you look at it and you memorize it, because practice makes permanence.
Yeah.
Doesn't make perfect, it makes permanent. And so if you go back to your bad trades and you go, oh, this was, and what are you doing? There are 100 ways to go bad in a trade. There are just a few ways to go right. So you go 1, 2, 3, 4, 1, 2, 3. All right, I got it. I see what I could have done there. Now, there's always epsilon. You can always get in and something can go, okay, well, I didn't see that coming.
Yeah.
And that's why you have your risk. You have your risk there, because if something comes that you don't see coming occurs, you're not going to end up with a gaping chest wound. It's going to be a finger cut, a paper cut. It's going to hurt, but it's not going to stop you from trading tomorrow. So when you find out, hey, how do I really sit down with yourself, take a journal, say, how do I feel about money? What do I want it for? Mm-hmm. How does it make me feel if I have it? And realize that we're all deeply emotionally connected to cash. We either are afraid of losing it, afraid of not making it, afraid of not keeping it. The list is long, but know how you feel about money and then make responsible decisions. Don't go gunslinging, because you'll end up with a failed exercise in the trading space rather than a successful one, because all the money managers on earth manage risk first. Right. They manage risk first. That's why they get to keep your money for 30 years or 50 years or 2 family generations or whatever. It's not because they throw caution to the wind going, hey, listen, let's buy this EV here at 80 cents because it's going to be, $75 in a couple of weeks, and then it'll be 300 in 10 years. No, they are very rigid in their approach to what they allow themselves to lose.
Right.
And of all the lessons, that's the hardest one.
Wonderful. Yeah, I think you've probably opened up a lot of people's minds and kind of made them realize things they were already starting to get. But I think you explained it really, really well, 100%. And Anne-Marie, I'd love to get now into kind of your trading style and maybe look through some charts. So I guess my first question would be, what's kind of your overall time frame? What's kind of your style, and what type of stocks you like to trade? And feel free to, if you want to explain something, to share your screen, and we can look through some ideas as well.
Okay, so I'll take the screen in just a wee bit.
Sure.
But first, I normally intraday trade the futures, but I do also sit in stocks. And no matter intraday trade or swing, I look at my weekly chart every single morning. Even if I look at it and I go, oh, yeah, it looks just like yesterday's, I'm going to look at the same thing every day.
Mhm.
I'm going to say, what are the traders doing here?
Mhm.
And the big thing that I've learned to do is to turn the candlesticks into a storyboard. And that storyboard is, hey, what are all the buyers saying to the sellers here? What are all the sellers saying to the buyers here? And if I were a buyer, where would my risk be? And if I were a seller, where would my risk be? And that means that word risk means at the moment it loses that level and it can't get back above it, that level right there is the one that turns me from being maybe I'm right about this to I am wrong about this. And that's where your stop should be. Your stop should be in a place where, you know what, if it breaks down, I'm wrong.
Mhm.
This is wrong. So I got to get out.
Right.
Your stop shouldn't be my arbitrary 1.5%. You'll drive yourself bananas because it'll drop down and it'll pull back up and you'll go, and you'll try to take the trade again and it'll do the same thing again. You've got to think about things big picture. No matter how small your picture is, you think big picture and you're going to sit on the right side of the trade for the majority of the time. So let me show you.
Sure.
I will first put the grid up here that I want to use.
Sure. And just while you're doing that, for everybody watching, we're recording this on Monday, the 22nd. So we just had a pretty volatile day in the market. A lot of growth stocks, especially, got hit pretty hard with some distribution, but I'll most likely have this up and out on YouTube tomorrow after the close. So we're not sure what happens tomorrow, but as of right now, we saw a little bit of heat getting taken by a lot of growth names in the market. So just for your reference and for context purposes.
All right, so this is the NYSE's 2-week highs minus the 2-week lows. And this one, the yellow one, is a comparison chart that is the 6-month highs minus the 6-month lows. Now, on a bullish day, let me show you what they normally might look like. On a bullish day, you would normally see the charts moving straight up, right? And the higher up they move and get higher, the more likely it is that price will hold its high levels. Today, look at what happened. Now, take a look at the last, comparatively speaking, look at what's happened to the broad market.
Right.
The broad market has gone from all these upward motions to some flattening action between Wednesday and the following week. And then this was into options expiration. And now here we are here. And though on Friday, pardon me, on Friday we had much lower levels, we still had this negative drift.
Right.
All the way down here. So here is the takeaway thought. Let's say you're an intraday trader and you're looking at this formation. I'm going to remove the comparison study here, right? So we can see it just by itself. And you're looking at it, let's say you're looking at it on a 5-minute. You want to see what's happening in the morning, and you can see immediately it begins to drop off, right? So notice, however, what the ES looks like. You know what? I'll use SPY. For the SPY today, let me get it from 9:30. For the SPY today, notice from 9:30 to 10:30, it moved straight up. And I'm going to use that comparison study. So what this did in the morning, here we're looking at the SPY on a 15-minute chart for today. We already talked about this 6-month high minus low, and it grew up in the morning until about 10:30, and then it started rolling down. Notice the disconnect here between 12 and 3. This was moving up, and this kept moving down. Here's the fantastic thing about market internals. market internals in continued motion will give us strength that ends up showing up towards the end of the day, as long as it doesn't change direction. Let's go to the past here. Take a look at this. This was Friday. It moved up, but the lows kept outweighing the highs. That's why it's a negative trend.
Right.
And then it started rolling over into these lower edges. So using an undercurrent motion is always something that I keep an eye on. All right. So my charts, I trade 5 different charts. And you're going to look at it and go, oh my gosh, it looks so messy. But I'll show you what I'm after when I take a look at my trades. I sit and I trade the ES, the NQ, the YM, the CL, and gold intraday, right? And so for me, the early part of the day, I came in, saw what happened on Friday, and I had this line written here, and I said, all right, it comes in here, support anywhere around 75.40, going to buy it. My stop is going to be just underneath this particular wick. And that's how I work with my chart. And so let's expand one right here. And this is a VWAP ribbon. And so let's take a look at SPY. We'll take an assessment of SPY today and we'll see what we anticipate tomorrow to look like. This is how I would set up for tomorrow. And this is how I would wait for what tomorrow has in store for me. Okay, so first thing I will notice is this is my 5. What I really like to do is use the open, high, low, and close, right? So it's sort of a typical price, not something with sharp curves. And so what I'll notice is this candle right here broke my 5 simple moving average to the downside. It closed under there. Now, prior to that, the last time I had something close under was over here, and then over was over here, and then under was over here. So you might be thinking to yourself, how is that going to help me with a 5? So here's what I do. I see these guys in the background, and I know that I've got a high from this time that it broke, right up here. I don't have any idea whether it's going to move there. And I have a low from this one that broke. And so when I came into the trading day today, the same sort of thing I began looking at in terms of my price action, saying, okay, if I lose my 5, what's going to happen to me? I love using this 5 because it ends up being a place where charts and traders will really argue, but they're also going to argue around this candlestick that closes over or under the 5 simple moving average. And we can see these 3 of them do this. And so these 2 are very close. And so I'm going to put a box around it. And believe it or not, tomorrow, these levels here are going to tell me what it is I'm going to do for price. So here's the first one. I'm sitting under here. Let's say we have a terrible fade, right? Let's say it fades and it comes into the low wick of Thursday. Comes all the way into that area and it begins to bounce. My thought process is always going to be the following. I'm going to look for this area. I'm going to look for the last time near that zone that I saw my price action cross above that 5. And I'm going to watch the chart come up above that level. Now, this is not a coincidence. Notice how the cross above here, holding near the recent low support edge, is almost spot on to the low that the SPY makes here. For this reason alone, on my 4-hour chart, I have a tendency to draw rectangles around the candlestick that has broken my 5. Now, that might be a little too noisy for folks. Some folks might say, hey, you know what? I don't want a 5. I want a 4. Or I want a 3. Doesn't matter which one you choose. What you do with it is going to make the difference. So notice, I just drew the one with the 5. Okay. And so we're going to throw the curve in there, and we're going to move it to a 3 and then watch how different the candlesticks may or may not be. Okay, so let's go all the way back here. Well, it doesn't really make a difference here. You might say that this is that edge, but this is still the one that closes above it. So nothing here. For this one, it's also the same. And for this one, it's also the same. That isn't how it is all the time. But what you'll notice is whether it's the 3 or the 5, because it's happening through an entire candle body, you might even use the 6 or the 7. Whatever it is, draw it, look to the left, look for support. Now, this might make a few people nervous because when they look at price rules, they go, no, I need a rule. And the market doesn't work like that. There are too many of us putting in too many things that we have designed ourselves, and large algorithmic programs doing all kinds of design. There's no exactitude here. It's all a shade of gray. So notice if you say to yourself, all right, you know, I see this wick, but I've decided I'm going to use an 8 EMA or whatever, and it ends up crossing near the top of your candlestick or something like that, you're still going to get a candle that gives you a range. And that range is going to define a stop action, and it's also going to define a recovery action. So tomorrow, here it is for me. If I see the chart getting up above 46, 463.50, I'm going to look for it to stabilize. I'm going to show you what stabilize means right here. We're going to go to the 15-minute candlestick from yesterday, and you're going to see this 463, not yesterday, Friday. We're going to see this 463 area right here. It's going to bounce. It'll pull back and test and bounce, and it'll pull back and test. So you might say, here's my edge on the last one. I'm going to buy it here. When you're looking at a downward formation and you buy, or you're buying underneath a moving average or underneath VWAP, what makes buying occur? People who are buying to open and people who are buying to close. If people who are buying to close are only closing half their position, and the people who are buying to open really aren't going to buy until they get on top of this candlestick, price action is going to hit a resistance level. And so here's something that you're always going to see. No matter what, if you have downward slope in any kind of moving average, and let me remove the VWAP, and we look at just this 5, any kind of downward steep motion, any bounce to the upside, traders are going to try and sell it off. It might take them 3 candles, it might take them 2 candles, but they are going to try and sell it off until there are enough buyers that say, you know what, I am going to stay and push price to the north.
Hey everyone, unfortunately we did run into some Zoom issues and had some thunderstorms impact internet, so we weren't able to complete the entire interview, but I'm sure we'll have Anne-Marie back on for part 2 at some point, and there we can focus a little bit more on the charting side of things. But I think the psychology, mindset, all of that just by itself is worth way more than just one interview. So I hope you did enjoy it. If you did, go ahead and leave a like down below and subscribe if you're new to the channel. I'll have links to all of Anne-Marie's website and Twitter down below. Definitely go ahead and check her out. And I'll see you guys in future videos. Thank you.